those are difficult today. So let us start this one session. Today we'll discuss about the RBI and FEMA related some regulations governing the import and export. We are not going with FEMA is a very wider subject. So we're not going to enter FEMA all the formalities and the regulations and etc. Only related to import and export we are going to discuss. Then we'll discuss about the export payment methods. What are the different methods are there? Documentary collection and documentary credit. So these things we'll discuss. And then we'll go with the export finance, pre and post export financing. Then banking formalities. These things we'll discuss. First, going forward, let us move with this RBI. RBI has a master directions. Generally, they give updating every time to time. They're updating. So these are governing for the all import and export related from the RBI. So RBI means they are controller of the FEMA and all regulations. What are they making? They are publishing these notifications that the master directions they used to call. So the master directions which is there that I'm going to tell you now. Okay. The latest master A is updated of this January 20. This one January 8th, 2021. This is the latest version, right? For the export. Then again import also there is a master direction. Okay. So I will show you in the master direction mainly what are those things mainly which are concerned to us, because this is a very wider subject as I told you, but which is relevant to us, that only we'll go to and explain to you. Okay. So in this is the master direction for export of goods and services. So in this master direction for export and import related, here this is export related for both goods and services. They give all the details. So here, for example, introduction, then realization, repatriation of the proceeds. Exports, when you are doing, within what period we have to get the realization. That is what very important from the RBI side, means FEMA regulations. So if not realized, then what is also they mentioned, what are the remedies. Then manner of receipt of the payments. These two are very important. Okay. So these we'll discuss, and to some extent, of course, we can discuss about the foreign currency account. For example, temporarily you want to put an exhibition overseas, there the payments they will give in the that overseas country local currencies, for example. In such case, how to make the temporary account, that I will tell you. Then about the EFC account, means exchange earners foreign currency account. This is very beneficial for those who are both import and export. Whenever we are making any export, what are the payments from the foreign currency, it has been converted into Indian currency. In such case, when it is converted, then the conversion rate will be different. For example, at present, for example, 76 is there. So $1 you are making export, so you will get 76 rupees. Example I'm talking about. Okay. So that is you are getting 76. But when you are making import, then you have to buy the dollars. Means you are paying in dollars, so you have to buy the dollars from the bank and then payment. So when you buy, they charge you 77. When you are getting dollars in export, when you are making, you are getting the dollars, then the conversion rate will be at 30, means 70. Hello. Yes, Srinivas, what you are done? Hello, you able to hear me?
Yes.
Then again, why this call has made? Mr. Srinivasulu, why you make a call? You join, no? Join already started. Okay. Okay. One more participant just he has called about. So this maintaining the exchange earners foreign currency account is very essential. Why I'm talking about? Suppose you are exporting a dollar goods, you are exported, for example, or services, you are getting $1, then it will be converted into Indian currency. You are getting say 76 rupees a dollar. But when you are importing, again there the conversion will be done. At the import, you have to buy the dollars from the bank. In such case, the bankers will collect from you $1.77. Means export you are getting 76, but here 77 you are getting. Means paying. So one rupees you are losing. So when those traders are the business people who have the both import and export, then for them it is very essential to maintain a foreign exchange currency in your account, so that whatever the inwards is there, inward the payments, the dollar payments for example, you keep in that account in dollars only, and then when you want to pay for the import, then you use this account and pay from this amount, this balance, that dollars, so that unnecessarily that conversion rates, that difference here, as you see, 1 rupees you are losing for every dollar, that can be minimized, that can be eliminated. So that is how this foreign exchange earners currency account, that is a very essential. So these things we'll discuss. Others of course not much required. So this much is required, so that we'll discussing now. Okay. So similarly for import also, I will show you imports also we'll discuss. So FEMA is actually introduced. FEMA is introduced in 1999 when we started liberalization. Then it is essential that our financial transactions also has to be open market like. So therefore FERA was earlier was FERA regulations. The FERA regulations are being replaced with the FEMA regulations. So effective from the 1999 they introduced, but effectively it come into picture from the 1st June 2000. From 1st June 2000 it is being effectively implemented. Okay. So this is about the FEMA. In the FEMA, as I told you, there are certain sections are there, 49 sections are there, but all the sections are not so much relevant. But for us, only section 7 only relevant. That is export of goods and services. This portion only is relevant to us. And the FEMA is applicable broadly for foreign exchange and foreign security, then export and import, both either goods or services. For the transactions, these FEMA regulations are applicable. Then first of all, we have to understand whenever we are making export, because previously we done some how to export and what are the export formalities, documentation, customs procedures, and all things we have learned. Now we are going to understand, suppose you have made an export, then within what period you has to get the realization. That is very important. Otherwise, again, there is a FEMA irregularities happen. So in general, they made this very clear that within 9 months, from the date of export. Date of export, for example, is taken the bill of lading, for example, for sea consignments. That is taken as a date to starting date. From that, within 9 months, you have to get the realization. Either it is from the EOU unit or SEZ unit or any other status holders or whatever may be exporter. For everybody, it is the same regulation, 9 months. But because of the COVID situation, during the export, during this up to say 31st 2020, then they extended this to 15 months. Only those limited period, not for the entire, but only limited period, they have extended this to 15 months because of worldwide there are certain difficulties for the transactions to happen. So therefore they made extension. Otherwise it is 9 months. Within 9 months we have to get. In case of the goods which are been put in a warehouse abroad, for example, you kept set in a warehouse in a UAE, from there you want to sell. When you have made some warehousing, then it is a 15 months you have to get the payment. 15 months from the date of the shipment of the goods. Okay, that is where the conditions means when you are shipped, that is from India. When is left for the warehouse in overseas, that India when it's left, that is the starting point from that effective date, and within 15 months you have to get the realization. So this is about the getting the realization in case of exports. That is what again the circular talks about the same. Then extension of time. Extension time, RBI has given to the authorized dealers, means the concerned banks, certain relaxation period, means they based on the credentials of the exporter, the banks can extend based on the some reasonable causes, then they can extend it. Each extension means they has to make only 6 months first extension, then maybe another 6 months, but within 6 months you have to, that extended period you have to get this one. Otherwise generally bankers also will not entertain unless otherwise very reasonable cause you have shown, then only it is possible, otherwise no. So extension of one time of say 6 months, and further of course depends upon the case, satisfaction of the bank, the authorized dealer, based on that they can extend. Okay. And for that also the exporter has to submit the declaration that the export proceeds will be realized during the extended period. They has to get that and anything while considering the extension beyond 1 year. You see, beyond 1 year. In beyond 1 year, then total outstanding of the export does not exceed say this much amount, 1 million or 10% of the average export realization of the exporter during last 3 financial years. So the limit also there, the amount limit also there, not that extended they can do any extension, but there's a limit based on the credentials of the exporter. The general they takes it 10% of the average of the last 3 years of the export of the exporter. Okay. So that is how these conditions are there. And manner of receipt and payments. The manner of receipt is very clearly they mentioned. We have to receive the, you see, as per the this foreign trade policy, para 2.52, all export contracts and invoices shall be denominated either in freely convertible currency or Indian rupees, but export proceeds shall be realized freely convertible currency only. So we have to receive the payments in freely convertible currency. However, again they mention, however, export proceed against specific exports may get some relaxation. You can get in rupees also. And Vostro account also, if we there, then also you can get in rupees. What is the Vostro account also I will explain to you. Then I will understand. This apart, from Nepal and Bhutan also we can get, because we have a treaty with Nepal and Bhutan, so we can get the realization, export realization in terms of the rupees only, not in dollars or on any other foreign currency. No need, only rupees we can get the realization. So this is the provision. Otherwise all our realization must be freely convertible, unless otherwise as per the RBI provisions, those has to be done. One is Vostro account, the other one is for the Nepal and Bhutan, we can get the Indian currency. Okay. Here as per this RBI regulation, that is as per the foreign trade policy I was shown to you. As per the this one RBI regulation, the manner of receipt and payment, the amount representing the full export value of the goods exported shall be received through an AD bank, means authorized dealer bank, those who have been authorized through banking channel only we have to receive, in the manner specified in the foreign exchange, this one regulations, this is what they're talking about. Okay. And this regulation they're talking about just in a I'll show you that notification. As I told you, this is what the master circular. Here what did they mention, let us see. Here the first is realization. They are telling within 9 months we have to get the realization. Here you see, within 9 months the period of realization and repatriation of export proceeds shall be 9 months from the date of export for all exporters, including units in SEZ, status holders, EOU, units in electronic hardware and technology park, or software technology park, or biotechnology park. These all things 9 months. Then manner of receipt also they mentioned in this notification. The manner of receipt and payment, the amount representing the full value of the, as I told you, shall be received in foreign currency. He has mentioned in the manner in the foreign exchange. Control this one. When the payment of the goods sold overseas, the buyers during their visits is received in a manner of EDF, means that a declaration, electronic declaration of the declaration form should be released by the AD, means that bank, authorized bank, only on receipt of the funds in their nostro account. What is the nostro and vostro accounts? I will explain to you. So only then it will be treated as a receipt, means payment receipt for the overseas sales. Okay. Now going to this nostro account and vostro account, I'm going to tell you what is those. The vostro account is, it is an account which is held by the foreign bank with the local bank. Means, for example, a US bank, they are maintaining in Indian bank, for example SBI. The foreign bank, they're putting account in Indian bank in Indian currency, or the currency, local currency. That generally the vostro account in our account, in your money, means our account in Indian rupees. They maintain the account, that is called vostro account. Then nostro means our Indian banks are putting a taking an account in foreign bank, and there they maintain the account in that foreign. For example, it in US, then they'll put that account in US dollars only, that account will be maintained. Okay, so that is nostro. So for example, you are making the realization of the payments. The foreign buyer from India, there is foreign buyer, means you are exporting. The foreign buyer will put the money in US dollars, for example in the nostro account of the our Indian bank, nostro account of the Indian bank. Then from the Indian bank, what they do is they give to us in Indian currency. The bank will give you us in Indian currency, but the foreign, that buyer has to put in foreign currency only. Foreign buyer has to put the amount in foreign currency. Then that amount will be converted by the Indian bank, and they will pay us in Indian rupees. Okay, so that is a vostro and nostro. Vostro means foreign bank is putting account in our Indian bank, and nostro means Indian bank taking the account in a foreign bank. The advantage of it is multiple times conversion and all thing need not be happen. So whenever our exporters going abroad, and for example they're carrying certain goods, suppose a jeweler, he want to carry certain jewelry for exhibition or for any of the show, and there he is showing to some people, some customers, and the customers likes it and they want to buy it. Then and there he gets the amount, the payment he will get there, but that amount he will deposit in a Indian bank, the nostro account. He can put in the nostro account of the Indian bank in overseas, so that he can get the payment in India in Indian rupees. Okay, means that is treated as a realization of the payment. Whenever he is selling abroad, the realization must be accounted. That accounting must be through banking channel only. Only through banking channel that payment has to receive. So for that reason, these facilities have been created, so that whenever the exhibition also, when people are going there and putting the exhibition, making the sales, then they can put the account either in the temporary account they allow, there they can deposit, or they can deposit through this banking channel, that what I told to you. Okay. The nostro accounts. Then SWIFT is generally is in a electronic transfer of the transactions between the banks. Between the banks, there's the electronic transaction. The SWIFT account is means from one bank to another bank, all the transactions electronically happens through SWIFT. It was introduced in 1973, and now almost like 212 countries that are doing the transaction through SWIFT only. Means suppose that you have submitted documents through SWIFT account, they will means announce also these documents are received and all. Otherwise, through courier and other thing, physical mode going is taking a longer time. But SWIFT, this one, they can communicate that receipt of the documents or the receipt of the payments and all this payment also they can transfer through that SWIFT accounts. Okay. Escrow account is in a third party transaction. Suppose a buyer is there and seller is there, and buyer and seller, they don't have a trust between them, because we don't know the very much about the credentials of the buyer, and buyer also has certain doubts about the seller for any of the transactions between them. Then what they do is they put a third party. Third party generally good credentials that banks and all things. Generally banks, they comes as a third party, and they put the amount in a third party, that escrow account. This is like this escrow account. Escrow is in a temporary account. The third party releases the funds only after the fulfillment of the contractual commitment. Suppose there is a buyer and there is a seller. Okay, when the seller sells the goods or dispatches the goods, he has a doubt whether the payment will be received or not. Similarly, buyer also have a doubt if he make the payment whether he will receive the goods or not. So therefore, what they do is they take the third party, that escrow agent. Escrow agent been appointed. The buyer puts the amount in escrow account, and the seller, after that dispatch, he may get, after the consent, he get the payment. So this is how it happens. Here the party A, for example, he transferred the funds to the escrow account. The buyer transferred the amount to escrow account. Then after that, he confirmed he got in a escrow account, then the buyer, means seller, will make the transaction. The goods will be transferred. The goods will be received by buyer. Then the bank will make the payment to the the seller. So this is how in between it comes a bank as an escrow account. It is a temporary account, but it is generally happen these transactions like this. If the buyer and seller doesn't have the confidence between them, these accounts happens. Then third party payments, whether third party payments are allowed or not, as per the RBI guidelines, third party payments for the export or import transactions are allowed, provided certain conditions are they made. Okay, that condition has to be fulfilled. For example, here taking into account the evolving international trade practices, it has been decided to permit third party for export or import transactions can be made subject to the conditions as below. The firm irrevocable order backed by tripartite agreement should be in place. That is very important. That means whenever you are getting the agreement between the parties of buyer and seller, in the agreement there must be very clearly mentioned that the payment will be sent by third party. So that is why tripartite agreement must be there. Means between that agreements, the third party name must be there with complete details that they will make the payment. For example, you are making export to the some buyer in US, and there is a third party, he will make the payment. So in a contract you have mentioned that third party also, and third party also must agree to that and for the making the payment. However, it may not be insisted upon the cases where documentary evidence for circumstances leading to third party payments or name of the third party being mentioned in the irrevocable order invoice. Then when it is there in the invoice, also there is certain requirement that payment should be received through third party, that documentary evidence must be there. Therefore, export declaration form also you have to mention that these exporters should declare in a third party remittance in the export declaration form, and would be responsibility of the exporter to realize and repatriate the export proceeds from such third party name mentioned in the EDF, electronic declaration form. There, whatever he had mentioned the third party, from that the payment must be realized. So that is a very essential condition, and it would be responsibility of the exporter to realize the repatriate the export proceed from such third party named in the EDF. Okay, so third party payments also allowed. Similarly, for import, for example, import also similarly, suppose you are imported but you are not paying, but third party is agreed to pay, so that also allowed. Okay, in case of import, you see, in case of imports, the invoice should contain the narration that the related payment has to be made to the name in third party, and the bill of entry should mention the name of the shipper, and also the narration of the related payment has to be made by the third party. Means in the bill of entry also you have to mention, in case of import, in the bill of entry you have to mention about who is going to make the payment, the third party. The third party details must be mentioned. So that is what the, yeah. Otherwise, when exporting, it is the exporter's responsibility to get the realization as per the FEMA norms, RBI regulations. So the exporter gets the realization in his name. Therefore, there will be comparison what have been exported related to it, that realization has been done in foreign currency. Okay, because always that matching is there. All the customs data will goes to the RBI also, because they are interrelated, interconnected. So what are the exports are happening, corresponding the payment has to be received, and these are updated always through banking channels, and customs and banking channels also interlinked, and RBI is interlinked. So these have been monitored by the RBI, and the corresponding banks also has to make the reports time to time to the RBI about these transactions. Then foreign currency account is as a temporary account. This can be granted for the exhibitions for trade fairs. For that reason, it's been mentioned. A participants in international exhibition or trade fair have been granted general permission wide so this foreign currency account regulations, that they can maintain a temporary, they can open a temporary foreign currency account abroad, so that whenever they get the realization, means whenever in exhibition they are getting the payments in foreign currency, those amounts they can deposit in that temporary account. Okay, so this temporary account is there. The exporters may deposit the foreign exchange obtained by sale of the goods at the international exhibition or trade fairs, and operation account of their account outside India, that balance in the account has to be maintained. That's all, right? So now non-realization of export proceeds. What is that? Already we told that extension is there. A 6 months extension they will give first. Then based on the credibility and credentials of the customer with valid reasons, another 6 months may be given. But if in above 1 year, there's a caution, and that is where you have to be very careful, unless proper solid reasons are there for non getting the realization. Otherwise the liabilities are there to return all benefits, incentives what you have taken for export. For example, export benefits we have discussed some time back, all type of export benefits what you have got it, like including the drawback, or including benefits under the advance authorization, or any of the EPCG, or whatever maybe you got the, or wrought up benefits, these also has to be returned back, because these are conditional benefits. Once this condition of the realization of the payments are received, then only these are applicable. Otherwise whatever you have received, it has to be returned back. Okay, payment through ECGC account. What is the ECGC account? We'll discuss that. Certain times we take the insurance through that. Also that provision is made. What are the through insurance we are getting, that will be set off against the non-payment. So suppose you are exported, and because of certain risk factors on country risk or some other risks are there, because of that that payment is not happened, then the ECGC will, because you have taken an insurance cover, the ECGC will pay. What are the payment you received through ECGC, that is considered towards the payment for this your exports. Okay, so that adjustments also can be done. And one more thing we have to understand, that now everything is electronic monitoring systems are made. So data processing and monitoring system related to import and export, very clearly they mentioned, otherwise you will be blacklisted. Mean that therefore thereafter you will not make any transactions through banking channels, or customs and all thing will not be happening. So for that, let us understand what is these provisions. This is one is export data processing and monitoring system. Whenever you are making the export, the corresponding relation of the payments, if you receive through banking channel, then banks will upload about the payment details against their shipping bills, or the forex forms, a softex form, that is software related. Means shipping bill means for the goods, and for the means suppose services, then softex form. So that has to be uploaded by the banks. The banks download the shipping bills or softex forms issued by the export agencies such as the customs or SEZ and Software Technology Park of India. From that, whatever they get, that the means exports are being done. Correspondingly, the bank will be uploading those things, bills, against the payment receipt only. After the payment received, then there is a reconcile happens. What are the goods or services been exported, to that extent we have received the payment. So that is why the reconciliation has to happen. That is through electronic system, that is EDPMS. EDPMS is very important, and certain people also getting notices because of this. If that not reconciled and not matching, then definitely you will get the notices. This data is then matched with the data on inward remittances of export proceeds from the exporting company. Means from whatever you received the realization in foreign currency or whatever the currency as permitted, that will be tallied with what you are exported, either goods or services, both has to match. That is very important here. What are they received from the custom data and bank realization from the your account. So these both has to be matched. If suppose you are exported certain goods or services, but corresponding payments are not received, then the AD bank, the authorized dealer bank, they generally every 6 months they are updating and reporting to the RBI. If they're not received in a reasonable time and permitted times, as I told you, within 9 months or extended 6 months, first extension, like that, within that extended period, if are not received, then these details will not be updated in EDPMS. So therefore it makes you blacklisting also can happen, so that you will be blacklisted. You will not be able to make any foreign exchange transaction. Your bank account will not be happen, and again your customs also makes troubles for you for means getting the refund of the benefits whatever you got, like drawback or any lot of scheme benefits and other benefits what you have got, that will be refunded. The similar provisions are made for import also. This import data processing and monitoring system. Here also, based on the bill of entry, those are been everything is online now. No physical documentation, nothing to submit to the bank or anything. It the banks will do whenever you're making the payment or payments are made through that, and the bill of entries from the customs, it will be uploaded by the bankers in the system. So the both will match from the customs as well as from the means banking channels, what is the remittances are being done. This is what this is a RBI caution caution list. If you are not made this one, then it goes to the caution list, and once it is in caution list, the exporters are denied packing credits also bankers will not give you any credits and all thing, and other transactions also they may stop, hampers their exports, and also so even if the goods reach the buyer on time, the banking documents get delayed, which will lead to extra cost and demurrage charges. It can happen because your transaction, the documents also bankers will not send, so it will stop the banking transactions also. So therefore you will be in a trouble if they caution list. Again, if you cautioned, then again to decaution, you have to submit all the related documents and prove that you have satisfied all the requirements, means that realization have happened in case of the export to the corresponding export what you have done. So then only they will do this. Okay. Then EBRC provisions also there. EBRC, because all these things now online only, everything is gets online. So earlier there was there physical copies banks are used to give. Now they stopped it from the effective from the almost in 2012. They stopped the giving the means hard copies. Everything is online. You can also download the online forms. So online only EBRC it is provisions. Receipt of advance against the exports. Suppose you got certain export order and also you got certain advance, then if the advance you received within 1 year time, you have to export it. The exporter shall under the obligation to ensure that shipment of the goods is made within 1 year from the date of receipt of the advance payment. Okay. The rate of interest, if any, this okay, but within 1 year you have to export if you get the any of the advance against the any of the orders. And delay in the submission of shipping bills. Again, let us understand the shipping bills means documents what you have made means you are exported, and corresponding documents you have to submit to the bank. So that is presentation, we call it. To the bank it is called presentation. In cases where the exporters present document pertaining to the exports, that must be done within 21 days from the BL date, and if not, then bankers again will take the notice. They has to bankers now RBI is given to the bankers some liberty also to handle it based on the customers' credentials and etc. Okay. This realization already we have discussed. Right of provisions also there, bad debts like that. Suppose something you are exported, and for example there are certain external reasons, not individually between the customer and the buyer, the seller and buyer, means exporter and importer, but something external factors like country risks. It is even not, you're not taken even say ECGC cover, and you're not getting the any of the payments because of the country risk. In such cases, the right of provisions also given to the banks. They can write off based on the credentials of the applicant. Third party payments already we have discussed. Foreign currency account discussed, EFC account. Okay. Now international payment methods will discuss. What are the different international payment methods are there? Let us understand. In international transaction, there is a buyer and there is a seller. Seller sends the goods and buyer receives. In return, the buyer makes the payment to the seller. So that is generally happens in the transaction. So the seller sends the goods, then after the payment is released through banking channels to the seller. So this is what the international transaction happens. Then the risks also involved, both for the buyer and seller. They have the different concerns. Both the buyer and seller has a different type of concerns. The seller always prefers, he requires the payment in advance. The seller or the exporter, he wants the payment in advance. But the buyer, he has a skepticism because he has a doubt if he make the payment in advance whether he receive the goods or not. So they had a doubt. So because the trust may not be there. Every time in a monetary business you can't trust with heavy amounts. So therefore both have the concerns. If the supplier exporter sends the goods, then whether payment will be received or not is a doubt. Otherwise, if you want advance, then the buyer has a certain concerns. Buyer tells, if I make the payment, whether I will receive the goods or not. So both sides the doubts are there. Therefore, some via media we have to reach out some settlements. Okay, for that we are talking about here. There are a lot of risks are there in international transactions, currency related, banking regulation related, credit related, transportation, packing, insurance regulations, like many risks are there. Some of them how to mitigate and everything will tell you. Okay, selecting the payment methods, there are various options you have to first think it of. Can you afford a loss if not paid? That is a business loss, because exports are risky factors, whether you can bear that loss or not. Suppose something waiting time is there, waiting for several months for the payments. Suppose you have given some credit, say 45 days credit you are given, or 90 days credit is given. On the 90th day you will receive, for example, the payment. Till that 90 days working capital, whether you can able to manage it, cash flows. So those things we have to discuss. Okay, this you are able to hear or not, you tell me, otherwise I will shift to other mode. You able to hear?
No, sir.
Hello?
No.
No. Okay. 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 I will go to the other one. I'll make this one.
Methods of receiving export payments.
Hello? Hello?
Sir, this was audible.
Audible now? Okay. Okay. Okay.
Yes.
So I will make this one. So listen to.
Our young entrepreneur Niku has got an export order. The prices and INCO terms have been negotiated. Niku has some doubts bothering her about the various methods of receiving payment. Does she receive payment before shipment or after? Can she be sure of payment after shipments? To answer her questions, we first explain what the various methods of payment in trade are. 1. Cash in advance. Here, buyer makes the payment before the seller ships out the goods. There is risk here for the buyer. Such terms are offered usually when the seller has a proven track record or the buyer knows and trusts the seller. 2. Open account. This is the opposite of cash in advance. Here, the seller ships the goods and then sends the documents such as invoice and bill of lading directly to the buyer before the payment is made. Buyer agrees to pay the seller at a future date as mentioned in the sales contract, usually 30 to 90 days after receiving goods. However, foreign buyers may press for open account terms since the extension of credit by the seller to the buyer is common. An export credit insurance may lessen the risk of non-payment to Niku. 3. Consignment. Consignment is a variation of open account in which payment is made after the goods have been sold by the foreign distributor buyer to the end customer. This helps reduce the direct cost of storing and managing inventory for the distributor buyer. For the seller, however, the risk of non-payment in payment is even greater. This risk would be lesser if the distributor is reputed with a proven track record. NICU may lessen the risk of non-payment using export credit insurance that covers for the goods in transit as well as when in possession of the foreign distributor buyer. 4. Documentary collections. Here, the seller entrusts the payment collection to his bank. NICU's bank would send documents and collection instructions to the buyer's bank. These collection instructions specify when the ownership of the goods changes and when the buyer's money should be remitted. The buyer's bank would carry out the instructions upon receiving payment from buyer and remit it to NICU's bank. There are two types of documentary collections. 1. Documents against payment. Buyer is required to pay as soon as the ownership documents are presented to the buyer's bank. 2. Documents against acceptance. Buyer is required to accept a time draft as soon as the ownership documents are presented to the buyer's bank. Payment should be made at the maturity of the accepted time draft. The time draft is usually for 30 to 90 days. Banks charge a fee for such transactions. Documentary collection doesn't offer a verification process and there is limited recourse in case of a payment default. On the other hand, they are usually cheaper than instruments like letters of credit. Letters of credit. An LC payment involves the buyer's bank and NICU's bank. Under LC, a commitment is given by the buyer's bank that payment will be made to NICU provided that the terms and conditions stated in the LC have been met. NICU then ships the goods and submits the documents such as invoice, bill of lading, etc. to her bank as proof of shipment. Once documents are submitted, payment is released. The LC protects the seller against non-payment as the banks make the payment without discretion of the buyer. An LC also protects the buyer since no payment obligation arises until the goods have been shipped by seller as promised. So, it balances the risks for both sides and is more secure, though not risk-free. Banks charge a fee for LCs, which is usually more than in other methods. We shall discuss letters of credit in more detail later. NICU and buyer can decide upon any method and should mention the same on her commercial invoice. Lastly, she should consider taking export credit insurance when required.
Hello.
Yes, sir.
Yeah, you have gone through it.
Yes.
Yeah, good. Now let's close this one. Yeah. Okay. So that export the payment methods we have now discussed. Again, further we'll show you the details. There are four methods are there as already discussed. One is the open account, advance payment, then documentary collection and letter of credit. That is actually letter of credit is generally we colloquially use it, but that is documentary credit, documentary collection and documentary credit. Under the document credit, letter of credit is one of the mechanism. Okay. Advance payments, we know before the shipment, the buyer makes the payment to the seller. Then the risk is, of course, the buyer always has in a trouble or risk that whether he receive the goods or not. On the other open account, the goods are shipped and delivered before the payment is due. Then the seller has in trouble because he has in risk whether payment will be received for his goods or not. So in both the cases, there is a certain difficulties. So gradually we are moving towards another method that is called documentary collection. Documentary collection, what happened? You make the shipment and then documents you submit to the bank, and bankers will provide to the other corresponding bank, and the importer, if he makes the payment, then the banks will release the documents. If the buyer is, that importer is not making the payment, then the documents, of course, the title of goods, everything is in a exporter's name only. But if the payment is not made by the importer, then he is in a great trouble, because shipment is already made. The goods may be reaching the customers of the destination point, and already if it is reached, then what he will do? Though you are holding the good title of goods, everything documents are still in your hold in the bank, but in your hold. But the consignment is reached, the customer is not accepting, not paying the and returning the documents. That is a risk in case of the documentary collection. Documentary collection is very simple, and it is means a lesser cost, because in letter of credit and all things, there is cost is involved in both ways for submissions and all these things, opening and submission of the documents, all these things, the cost is involved. But in documentary collection, the payments cost is not involved, much of the banking costs are not involved, so it is good. But if the buyer and seller has a good confidence, definitely when the means this exporter make the exports, then he is very sure, 100% sure that the payment will be released. In such case, documentary collection is very good method. Therefore, both the parties are saving certain amount. Okay. On the other hand, if both the parties have suspicion on each other, there is via media we can go about, that is through letter of credit. Letter of credit is a guarantee that bankers are giving in between, that if certain conditions fulfilled, then the payment will be made. That is, the bank is making commitment. So this is a little bit of commitment by the bank. Therefore, it is very secured. So most of the international transactions happens in the through letter of credit. So what is the letter of credit related aspects? Let us discuss further. One by one we'll go all these payment methods. So the buyer and seller risks. Suppose the advance payment, as I told you, for the seller it is a low risk. Sorry, the seller is low. Okay, the payment in advance if you make, the buyer who has made a payment, he has at a high risk, but other hand, the seller at low risk. Letter of credit gives a both way a balanced one. Both way it is balanced one, it will give. And document credit also has a problem, as I told you. The supplier means the exporter, he's made first export, then documents are submitted. So already he has made export, so that he has in risk. So one we are discussing now is documentary collection. Documentary collection means it is for the, there are two methods are there, DA and DP. What are those two methods we'll discuss? DP means documents against payment, means you have made an export, you have already made an export, all the export documents you have submitted to the bank, and that bank is forwarded to the corresponding bank of the importer, and the importer has to make the payment to the bank and return the documents. Then only bankers will give the documents, so he can return the documents. Those are the in that documents also includes the BL, means bill of lading, that is the title of goods, so that the importers can release the goods only after the payment. That is called DP, documents against payment. The documents, the bankers will release the documents only when payment is made. The other form is documents against acceptance. Documents against acceptance means there is certain credit is extended. For example, as a 45 days, the importer can make a declaration to the bank that in a due date, the due date of say 45 days, in a due date he will make the payment to the bank. He makes a declaration to the bank, and with that assurance the bankers will release the documents to the importer. But he is not made the payment. The payment will be due in a due date, maybe 45 days or 90 days or 60 days, whatever may be, as per the agreement. That payment will be released on due date. So that is what these transactions. Okay. Document collection, how again it happens, again I will explain to you. There is a exporter. Exporter makes first the shipment. Here the first he has made the shipment. Okay, he make the shipment to the buyer, and the documents he submit to the bank of the exporters bank. Exporters bank, he make the submitted the documents. Then exporters bank, they will forward the documents along with mainly the bill of exchange, along with other documents. They'll submit to the importers bank. That is a collecting bank, we call the collecting bank. And collecting bank will release the documents to the buyer, and in turn they take the payment. Only on payment only they release the documents. Then what are the payment received? The collecting bank will send to the remitting bank, and remitting bank will make the payment to the exporter. So this way the payment is received. Okay, but here, as already we explained to you, the risk is on the completely on this exporter. The risk is mostly on the exporter. Suppose the exporter is made the shipment, because he is first making the shipment, already has made a shipment, and the goods are reached, for example the destination port. The destination port is reached. When he made the documents to the bank, and banking channel is sent to this importer, but importer is not releasing, he is not making the payment. If this payment is not made, then of course the bankers can't help. There is no commit from the bank, so the bankers will not make any commitment, so the payment will be held up. But the goods are reached the destination port. In such case, is a greater risk to the exporter. Alternatively, the exporter, what he has to do, then he has to make the some other buyer has to find out in that country, because already the goods are reached in that country. Some other buyers has to find out. Immediately finding a alternative buyers is very difficult. Certain times may not be possible. Meantime, the goods getting detention damages in the port. Additional cost has to be incurred. One side the cost is increasing, other side he may or may not get the buyers. And of course there is a provision to bring back the material also. Again, there is an additional cost of shipment, and all the transaction costs are involved. So therefore this is a heavy risk to the seller or the exporter. This type of transaction happens when you have a confidence on the buyer. The buyer will make the payment, that confidence is there, then definitely this type of things works out, otherwise no. Okay, then comes to the letter of credit. Letter of credit is in between that bankers are coming for the commitment. Bank's commitment is there, therefore it is a good method. Bankers will make the commitment subject to condition again. Subject to condition means what is there as per the letter of credit. All the terms has to be fulfilled. Then only the banks will make the commitment to make the payment. Okay. If the documents are not in order, means not as per the letter of credit, the terms, then of course discrepancy can arise. Then bankers' commitment will not be there. In such case, the buyer, for example, accepts the discrepancies, then of course the bankers make the payment. Otherwise, bankers will not release the payment. Means it is secured, but still some cautions we have to take about the documents. Therefore, the documents in export field is very important. Okay. This is a form of written undertaking by a bank on behalf of the buyer. Okay. And that the payment will be made by the bank for the goods and services supplied by the seller, provided the terms and conditions of the documentary credit are complied with. A LC is a direct undertaking by the issuing bank, generally the bank of the importers bank, to the sellers or the exporters. The documentary letter of credit, that is what we are calling it. The general name is documentary letter of credit, or LC generally we call it in normal parlance. In normal parlance, we call it a LC is irrevocable. What is irrevocable and other thing? Let us understand also. Irrevocable means once the LC is established, then who has been established, that opener, we call opener. Opener means who has established the LC. The opener ceases to make any amendments. Means whenever the amendments are required, the consent of the buyer has to be taken. Otherwise, that can't be amended. It is irrevocable written undertaking by the commercial bank issued at the request of the buyer applicant in favor of the seller, to the effect that the payment of certain goods and services will be made against the complying the presentation of the documents. These are being guided by UCP 600. What is the UCP 600 also I will share. And before that, let us go to the LC, how it is operate. Let us make a small video.
Letter of credit. In a previous video, Niryat Bandhu explained to Nikhu the various payment methods, one of which was letter of credit. Since LC method is an important method of payment, we will explain them in more detail here. To begin, an LC payment involves the buyer's bank and Nikhu's bank. Payment is made when seller submits the documents such as invoice, bill of lading, etc. to her bank as proof of shipment. The LC protects the seller against payment default by the buyer. An LC also protects the buyer since no payment obligation arises until the goods have been shipped by seller as promised. Who are the parties involved in a letter of credit? The applicant is the buyer who approaches its bank to issue an LC in favor of the seller. The buyer's bank is called the issuing bank. Nikhu, the seller, is the beneficiary in whose favor the LC is issued. Advising bank is the bank which receives the LC from the issuing bank for the beneficiary. Besides the advising bank, there can also be nominated bank and a confirming bank on behalf of the beneficiary. What are the steps in a letter of credit? Buyer and NICU agree to the terms such as means of transport, period of credit offered, the last shipment date acceptable, etc. Buyer applies to the issuing bank for the issue of LC. Bank then evaluates the buyer's credit standing, etc. On issuing the LC, the issuing bank sends it to the advising bank through mail or electronic means such as SWIFT. Advising bank informs NICU. NICU checks the conditions mentioned on the LC against the agreement. NICU ships the goods and puts together the documents like bill of lading, etc. called for in the LC and submits to the advising bank. Advising bank checks the documents against the LC. If found correct, it pays NICU and forwards the documents to the issuing bank. Issuing bank debits the payment from the buyer and releases these documents to the buyer. What are the benefits of letters of credit? Letters of credit are legally binding and all parties must honor it. So, they offer less risk for the buyer and NICU. They reduce ambiguity and increase transparency for both sides as the details about the goods, its delivery, etc. are all well defined in an LC. Letter of credit operations are governed by UCP rules framed by the International Chamber of Commerce, that is ICC. LCs are internationally used. It provides firms confidence to trade in unfamiliar markets with unfamiliar suppliers. What are the different types of letters of credit? Irrevocable letter of credit. A revocable LC can be changed or cancelled by the issuing bank on its own. On the other hand, an irrevocable LC can be changed or cancelled only when all parties, that is, the buyer, seller, and the mediating banks agree. NICU should always try for an irrevocable LC. Confirmed letter of credit. This provides additional security for the seller. Here, another bank other than the issuing bank adds its guarantee. If the buyer's bank fails to make payment, this confirming bank will guarantee payment. Usance letter of credit. Here payment is released at a later date and not immediately on receipt of documents. Back-to-back letter of credit. This is usually opened by a middleman who would buy from NICU and sell to a buyer. The original LC is opened by the buyer for the middleman. The middleman then opens a back-to-back LC for NICU against the security of the original LC. This gives security of transaction to the buyer, middleman, and also to NICU. Transferable letter of credit. These again are used when middlemen are involved. Under this LC, the middleman can request the nominated bank to transfer the payment directly to NICU. Standby letter of credit. Unlike a standard LC, a standby LC allows seller to obtain payment even when the buyer has failed to pay as per the bond. This is similar in nature to a bank guarantee. Red clause letter of credit. This allows the seller to receive partial payment prior to shipment. When taking an LC, NICU should make sure to check the conditions on the LC. She should also check the credibility of the issuing bank. Further, she should note that LC is still subject to risks such as change in buyer country's policies or risks of fraud, etc. by the buyer. Hope this video helps NICU in finalizing an LC. Niryat Bandhu wishes NICU all the best.
Okay, heard that video? Hello, hello.
Yes, sir.
Yeah, you able to listen that video?
Yes.
Yeah, okay. So fair basic understanding is there from the video. More details, of course, on the LC. UCP 600 guidelines are there. This is a universally they have to follow. That is a in International Chamber of Commerce formulated these guidelines. and all over the world, all the banks and everything, they follow it. These are called rules. Rules are not acts. Act and rules are differences. Act is binding in nature, but rules are not binding in nature. So act is only binding, but UCP is a UCP 600 is not act. But these are the rules. If you follow it is good, but everybody follows, everybody insists to follow. All the banks insist to follow with the UCP for 600, all the transactions. So it is become a binding. Otherwise, it's not actual originally binding, but otherwise everybody following and made it the practice of compulsory like. Okay. So we had to follow with UCP guidelines. What are the UCP guidelines and other thing also we'll discuss. UCP, these have this many, these are the different articles. There are 39 articles are there. These are the articles, 39 articles. Some of them, of course, we'll discuss over time. Okay. And also they made electronic presentation provisions because of the nowadays many conditions are there. It is not possible everything documents to send through hard copies and transmission of those hard copy documents, then it will be difficult. So therefore e-versions also been introduced, and therefore the means bankers also now accepting e-transactions. Okay. The documents are being transmitted through electronic provisions, electronic presentation. Okay. For the UCP 600, I'll show you one of the video, but video voice is not coming, but I will show you that video and I will explain you one by one. Okay. Because that is binding principles for the all LC operations. Certain times the LCs are there. We are thinking that is a very sure and secured way of the payment, but it's always not. There are certain things also can make the trouble, because small issues also the buyer tells it is a discrepancy. So once the discrepancy is there, the banker's liability freezes. They will not make the payment because there is a discrepancy. So what can be discrepancy? Maybe small mistakes also can form a discrepancy. Even minor mistakes also can form a discrepancy. Then again, it is a lead to a risk. So therefore, what is this? And bankers also in between, they also playing many games, because certain times what happened, that's for example, the documents are submitted. Any discrepancy they found, even the buyer is accepting those discrepancies, but when the acceptance of the discrepancy, the bankers will charge certain amount. Otherwise, the LC transaction, they're not getting much of the relation of the payments, because bankers also business. The amendments whenever required are in, whenever the LC amendments or LC discrepancy acceptances are there, for each of that, the bankers will collect certain amount. That is the biggest business for the bankers. So therefore, the bankers also always see what are the discrepancies. The banker side only, they scrutinize the documents, then find these are the discrepancies. Then they put the discrepancies before the buyer and seller. Then of course the difficulty is that that buyer even accepts, then the payment for the discrepancy has to be made. For each discrepancy, there are certain payments the bankers will collect. So that is the income for them. So therefore, though it is an LC, we think that is a very secured way of the payment, but there is associated risks are there. Okay. Some of them let us understand for the article wise. Each of the article wise, what are the payment elements UCP talks about. Understanding these provisions, UCP also provided what are the constitute as a minor mistakes are there. Those are not treated as a discrepancy. Those also they mentioned it. That is what the interpretations and other thing very important. First is the definition, then interpretations. Okay. Now we'll open this A. If the video is okay, I am sure that you are able to see the screen. Screen you are able to see.
Yes, screen is visible.
LC, LC laws, ICC, these able to see.
Yes.
Yes, okay. So let us move this one. So ICC made these provisions. Just a minute. So ICC Internet Chamber of Commerce made these provisions. I mean UCP at DC they call documentary credit. Documentary credit means related to LC. That is a 600 is the latest version. 600 is the latest version. Here we see it is like almost like a bank guarantee that banks comes intermediately and banks give the guarantee to the seller that they will make the payment if the all the fulfilling the conditions are fulfilled, complied with the documents. Only the conditions means only documentary conditions. They will not see whether goods or services happened or not. They're not bothered about. They only make the documents are in order as per the LC terms, then they'll make the payment. That is the commitment they'll make. Okay. And one more thing, let us understand here. You have a contract. In contract, maybe a number of terms you have stipulated. But when the LCS come, there is some other terms, for example. Bankers always concerned about the LC only, but not concerned about what you have an agreement with the buyer and seller agreements. They're not concerned. They are concerned about LC only. LC, what is the terms and conditions are there? The documents are required. If all those things are fulfilled, then they will make the commitment to make the payment. Only to that extent. But what is written or not written in the contract is means your buyer and seller contract is no relevance for the bank. But as a good practice, generally what happened when the LC you want to open, then the bankers will ask you to provide the copy of the contract. Based on the copy of the contract only, they establish the LC that both are in alignment. Both the contract between the buyer and seller and the LC terms are in alignment. Okay, then only they will make the opening. For example, after the LC is opened, the contract is between buyer and seller. They make amendments also. So those amendments may or may not reflect in the LC. But when the transaction happens, the documents you have submitted and the documents should comply with the LC terms only, not the contractual terms, because contract you must have made some changes also, but those are not reflected in LC. So bankers are not bothered about your contract. Only as per the LC, what are the terms are there, only accordingly they'll make the payment. Okay. And then let us take some more definition part. Here the parties involved are the bankers, importers, exporters, transporters, insurance, all these definitions are there. The first article of the UCP 600 talks about the definitions. There are various parties involved in these transactions. So all those definitions are being mentioned by the EA. That applicant, issuing bank and advising bank, beneficiary bank. Okay. The applicant means, for example, the buyer make the application to the buyer's bank for the making means opening the LC. He is an means applicant. Issuing bank means generally the buyer's bank who issues the LC, means who opens the LC, or opening bank also we call, or issuing bank. Then intermediary, there may be advising bank, means that buyer's side means seller side. Now seller side may be advising bank must be there, or some intermediary banks also may be there, or confirming bank. If the LC requires the confirmation, then confirming bank. Then beneficiary means generally the exporter. The applicant is generally importer, the beneficiary is an exporter. In between these banks are there. Okay. Then as I told you, confirmation or confirming bank, then complying with the presentation of the documents are some of the important definitions made in the Article 2. Okay. Then comes to the Article 3. Article 3 about the interpretations. Interpretations, here let us understand there are certain discrepancies certain times happens. For that they mention oblique or dash, and these terms are they're not mentioned. These terms are not mentioned, the discrepancies. So the word singular and plural same meaning. This is also an interpretation they made. For example, I will tell you, suppose you send a box of say 100 pencils. A box of 100 pencils you have sent, but you written as a pencil, singular you have mentioned. It is actually must be plural, because pencil 100 you have sent, pencils must be there, but you mentioned as a pencil. So the singular you mentioned, but plural is the meaning of that what your transaction has done. So this is not taken as a consideration discrepancy. Earlier, before these clarifications, bankers also and buyers also making certain game with this small discrepancies like singular and plural, he and she. These things also creating certain trouble. Suppose you are written he, and it happens to be that person is a she. Say she tells it is marked to he, but I am not a he, I am she. So I am not to make that a discrepancy. So therefore they made these type of certain things which are very common parlance. We make he or she like that, or it. These are the same meaning. Either if he is mentioned she, also includes the he. If he mentioned he, also includes she. Like that they made a clarifications. These are some of the things I am telling. And misspelling, for example, like the small mistakes are there in spelling, these also may come as a discrepancy. Discrepancy means in documentary discrepancy, any spelling mistakes also may take treated as a discrepancy. But the interpretations they very clearly mention now. Small mistakes, like for example machine, we call as a machine, this SHIN. And the English also, suppose color in English means British English, we write as a COLOUR, that is color as per the British English. But if American English you see COLOR, U has removed. So like that many things are there. Suppose realization, that yes we call it realization, we are talking about yes we write down generally, but Americans write the judge. So therefore the spellings are nowadays many countries have, even though it is English only, British English is different from the American English. So small mistakes, anything happens, that should not constitute as a discrepancy. Okay. Similarly, fountain pen or fountain pen, like that spelling you see, is not treated as a discrepancy. Okay, because it is intentionally not made, or some spelling mistakes by means errors can happen, or some practices like I told you, color and color. The both in American English and British English has a spelling, some distance is there, but meaning is same. So therefore they made these type of errors can't be constituted as a error, means discrepancy, because in LC discrepancy is one of the major means difficulties in LC. Okay. So similarly, the abbreviations, there is also they made. Suppose limited, you need not write limited, the full form, but if you writing short form, but in general trade parlance it is been understood, then those also not treated as a discrepancy. Okay. And one more very important aspect is LC, these revocable and irrevocable, and generally nowadays taken is a irrevocable only. Revocable LCs are not operational now. The simple reason I'll tell you, revocable means the buyer, once he opened the LC, means through banking channel, the buyer can change the LC terms. Suppose the seller is prepared everything, export is ready or already made export, but meantime the seller changes the some terms and conditions, some prices changed, some quantity has changed, or some other changes has made, then it is a very difficulty. Then LC is not secured. The seller is at risk now. So therefore, the UCP, the interpretation calls, unless otherwise LC is silent, then it is treated as a irrevocable only. By default condition, it is irrevocable. But if anybody made revocable, then it's a caution mark. Revocable should not be entertained. Many of the countries also made certain restrictions on the operation of the revocable. Revocable should not be there, so that all these things should be irrevocable LCs only. That means once the LC is established, the applicant means the buyer. The buyer has no right to make any changes. If any means changes are required in amendment required in LC, then the beneficiary consent has to be taken. Beneficiary and the bank both has to make amendment, not the means this opener, this applicant on the request of the buyer or the beneficiary means the exporter, then only amendment can be made, otherwise no. Okay. Similarly, some other terms we see, use of such class like first class or well known or qualified independent, like suppose inspectors, like goods inspection for example. A reputed inspector or independent inspector has to inspect. There's no such meanings are there in the that UCP 600. You have to specifically mention who is those agencies. Suppose in an inspection, SGS, Lloyd's, like that you have to mention very clearly, Veritas. These are the some of the reputed, for example, for your concern, you have to mention specifically. But leaving like vague, that reputed, independent, qualified, those has no meaning. Okay. And prompt and immediately also has no meaning. Okay. Then it is about the stale BL. It means BL before or after LC opening date. Those are stale BLs. What is that? I will tell you. Suppose the shipments are made before the LC opened. The shipment is made before the, for example, shipment is made and BL you got it, but LC is open later. Let us say on 25th April you made a shipment and got the BL. The BL dates is very clearly 25th April. That LC you are received on 1st of May. LC date is 1st May. So this shipment can be considered under the LC or not. So definitely it will not considered unless otherwise you have specifically mentioned there in the LC. Otherwise LC is prospective. From the date of the LC only, in future date you have to make the shipment, not on the past date. Okay. So in such cases, this BL is called as a stale BL. Stale BLs will not be considered in general. But if the LC tells even the shipments done prior to the opening of the LC also can be considered under the LC, then of course it can be taken. Okay. Third party documents, unless otherwise it is very specifically mentioned, then it has a no meaning about third party. Like for example, other party documents you are submitting, that is, it has to be mentioned very specifically in the LC, then it will be taken, otherwise no. Corrections in the documents issued by the beneficiary and legalized by any authority, the authority has to authenticate the same. That is again important. Suppose any of the some documents which he has to get from the authentic person or agencies, like inspection, SGS inspection you have done, for example, and any changes are there in the document, that authentic the agency has to make the endorsement of the changes, otherwise that will not be considered. And bill of exchange, what is the bill of exchange we will discuss today. That is a demanding, you are demanding as a exporter to the importer, the buyer, to make the payment. That is a demand. That bill of exchange is nothing but demand. Generally bill of exchange forms a first letter. On the top of it, the top letter, on that, this is like a covering letter. On that all the documents are submitted in support of the demand. So the bill of exchange is a demand from the exporter and demanding from the importer to make the payment on certain date. And any changes are required in the bill of exchange, then it can't be made. Again, you have to resubmit the document. Okay. Again, here one thing, last time also I told you, LC is a separate transaction from the contracts. Contract is maybe A and B, the importer and exporter have a contract that has no relevance with the LC. LC is on independent as a contract. That is an agreement that bankers are making the payment subject to fulfillment of the conditions in the LC. But otherwise, there is independent. Suppose some other conditions are there in the contract. The contract is not a binding for the, that is not binding for the this transaction through banking channels. For the concern of the banks only we are talking about. Banks are concerned about the only documents, and documents should be as per the LC terms only, no other contracts. Okay. Banks deal with the documents only and not with goods. Again, this is very important. Whether goods are reached or not, or goods are made or not, is no concern to the bank. There only deals with the documents. As per the documents, if it is complying with, then they will release the payment. Otherwise, no. LC must mention expiry date. This is as per the Article 6. The LC, whatever your opening, that should have a opening date, means that is a LC opening date, that LC date, and expiry date also must be there. There are two types of expiry dates are there. One is for the shipment, another is for the submission of the documents. Okay. Submission of document, general conditions are within 21 days you have to make the submission of the documents from the date of shipment. Date of shipment generally taken as a BL date. So the BL date is a date, and this expiry date, that BL date and expiry date of LC you have to very clearly we also see. Within the expiry date of the LC, the shipment must be made. Therefore, that BL date must be before the LC expiry date. Okay. So as I told you, there are two dates are there. One is the LC must, the expiry date means the last date of the presentation of the documents. That is the documentation presentation. But another expiry I told you about the shipment. Shipment they write again clearly, before the shipment must be made on or before so and so date. So that has to be mentioned. That date has to be made as per the BL. That date has to be seen as a BL date, and BL date must be before the expiry date for the shipment mentioned in the LC. And place of expiry also very important. Place of expiry, which place you are presenting the document. The document you have presented, but which place you have presented the document, that is also required. The place also they mentioned. Expiry date and place also they mentioned. Here the issuing bank means the LC opening bank. The LC opening bank takes irrevocably bound to honor compliance presentation. That is as per the Article 7. Means that is the binding. This is the bank has to make the payment. That is a obligation on the bank. That is why this is a contract between the bankers and the LC is a contract agreement. The bankers are agreeing to make the payment. That is an obligation they've taken on behalf of the this applicant to make the payment to the beneficiary on particular due dates, subject to compliance of the documents. So that bankers are irrevocably taken the means bankers can't change this one. They has to make they has to binding to make the payment, subject to presentations are in comply with the means documents all in comply with the LC. It is bound to reimburse to the nominated and nominated bank. Okay, payment has to be sent to the through banking channel only. Even if nominated bank or confirming bank fails to honor, it is ultimate bounding of the issuing bank to honor the compliance presentation. Suppose intermediary, there are other banks are there involved. So by example, like a confirming bank or other advising banks and other thing, but it is the obligation from the issuing bank that application means those bank which has made the LC open, that bank is in obligation. Okay. The confirming bank will add confirmation only if requested by the issuing bank to confirm. Okay, the confirming bank means intermediately there is a confirming bank, but certain times what happened, the issuing bank, that country conditions are not good or you don't have the faith. Examples I'll tell you. Some of the frauds also happened, some frauds happen, and some banks also not honored the payments. Example from the Bangladesh, for example, some of the banks in Bangladesh, they're not honoring the LC, even though all the terms and conditions are satisfied, they're not honoring. So therefore, this is certain conditions because of the prevailing condition of the bank or bank policies or company policies or our country's policies or other certain times this type of risk can happen. So people going with confirming bank through say Singapore bank, because Singapore is practices are good, very fair practices they follow. So we, for example, we wanted a confirmation is required from the Singapore bank, an independent third bank. In such case, the confirming bank now takes the obligation to make the payment. Okay, so that is what, if the confirming bank is not willing to add, and it must inform to the issuing bank without delay and advising the LC. Okay, if the if confirmed to honor compliance presentation, then the confirming bank is mentioned, then confirming bank takes the obligation to release the payment. That is why whenever we have a doubts about the credibility of the buyer and the buying banks, their country also, certain times African countries very risky, even the banks are not able to honor it, those are risky aspects. In such case, you ask for a third country bank, that is a third bank that confirming bank has to make. For example, now if you want to sell anything, export to the Sri Lanka, Sri Lanka is in very great trouble. There is no foreign currency available in the banks and all things. They are in trouble. They may not honor it because the country risk. If the banks are not honoring, then how you will get the payment? You are exported. Exports are went, for example, to the Sri Lanka, but they're not able to honor that payments. In such cases, you wanted a third party bank, that is a confirming bank. So confirming bank takes the obligation to make the payment. Even though the issuing bank is not paying, it is the confirming bank's responsibility. They have to release the payment. Of course, in case you are engaging the confirming bank, then additional cost is there. So confirming bank may take 1% of the transaction cost or 0.1%, like that, some amount they will add it, additional amount based on the risk factors, the country risk and the banking risk and other things. They'll see accordingly the premium they charge. Okay. Advising bank's responsibility is to satisfy its authenticity. Any amendment must be routed through the same bank. Again, LC, what are the amendments you wanted? Again, it has to be given by the issuing bank only. Issuing bank is open the LC, so that is opening bank. The opening bank only has to, that the same routing it has to happen. Again, it has to reach to the the Indian, for example, this exporter is in India, Indian bank it is reaching, amendments should reach to the same bank. It is not through any other bank, because original LC also received in the bank in India, and same bank amendments also should be routed through same bank. That is not advising bank. Advising bank means the beneficiary's bank. Opening bank means the applicant's bank. Okay. LC can't be amended or cancelled without the agreement of the seller, beneficiary. This is very good condition. Therefore, LC is more secured. Unilaterally, the buyer or the importer can't make changes. Only it has to be taken from the beneficiary, means the exporter's consent, then only it will be amended, otherwise no. Unless seller advises non-acceptance of the amendment, it deems to be notification as accepted. There is no time limit for this effect. Okay. Partial acceptance and nothing, there is no such concept. Accept means what are the amendments, accordingly has to be done. No partial again amendments like that. Issuing bank nominates the bank to advise the credit. This nomination does not impose any obligation on nominated bank to honor the nest. What is happened? The opening bank is there, the LC opened bank, that is routing through that LC through a issuing bank, means in our country India, the beneficiary bank. Beneficiary bank, that LC is coming through beneficiary bank, and the beneficiary bank, that is what the issuing bank, no obligation, because the obligation taken by the opening bank, that is the importer's bank, not the exporter's. Beneficiary bank has no obligation. Okay. Bank to bank instruction. All the negotiation and nothing, the this exporter has to negotiate the documents in the advising bank, means beneficiary's bank, and that bank will forward the documents to the opening bank. Then buyer has to means make the payment and retire the documents. That is happening. Right? A separate guide also they mentioned about the banks, means banks related obligations. That is called ISBP. ISBP regulations are there. The current regulation is 745. International Standard Banking Practice for the examination of the documents. Here further guidances are given for the banks. It is not like others, but it is for the banks, what they have to follow, what they have to do. Here they mention that the nominated confirming or issuing bank each shall have the maximum of 5 days to decide if the presentation is complied or not. Suppose you are submitted the documents to your bank, the bank has to decide within 5 days and intimate to you whether the documents is okay or not. If anything not okay as per the LC terms, for example, they has to mention within 5 days. Days means here the 5 days means 5 working days. 5 working days, again which country? The operating country. Okay. In that operating country, that 5 days, within 5 days, any discrepancy or there are acceptance, non-acceptance is there, they has to intimate to the beneficiary. For example, beneficiary is submitting the documents, means the exporter is submitting the documents to the bank. That bank has to tell within 5 days. That is what the meaning. Only invoice to show full details of the description of the goods as per the LC. All other documents to show only general terms, not the contrary with the LC description. Okay. The LC is the most important document, commercial document. The LC, what is the description is there, and that is very important to consider. And all the other documents to show only the general terms, but it should not be in contrary to any of the description of the LCs and all. But LCs and certain times they will not write the full description, but invoice you are writing the full description. It is advisable to avoid any discrepancy or anything. what are the invoice description you want to make, means in the contract whatever you want to make the description of the goods or the services, the same description you mention in the LC and insist that it has to be complete. Otherwise certain times discrepancy happens. Okay. Documents to be issued by the authority as per the LC in absence of that document will be accepted as presented. The document to be issued by the authority as per the LC terms only, as per the LC. In absence of that document will be accepted as presented only, but not acceptance. Unless mentioned in the LC, document issued prior to the date of LC is acceptable. Here see, unless mentioned in LC, document issued prior to date of LC is acceptable. Stale BLs also acceptable, but if you mention it is very good. Shipment documents or shipments prior to LC also accepted, otherwise discrepancy will happen. Unless otherwise mentioned in the LC, documents must be presented to the bank within 21 days, as I told you also earlier. RBI also following the same regulations, so it is international regulations. Generally within 45 or 21 days, within 21 days the documents should be presented to the bank. Okay, but not later than the expiry date again. Okay. Document not asked under the LC will be disregarded. Suppose you are submitting some additional documents that is may not be required as per the LC terms, that is your option, but that will be presented and forwarded, but that's not taken for it, granted for the submission of the documents. Okay. If LC contains any condition without asking any supporting documents to that effect, bank will disregard that indication, because banks deals only in documents. So here bank, because LC terms, what are they talking? We are not talking about the goods or services or anything, but we are talking about only documents. Here the LC is referring only for the documents. So what is their documents must be supported, documents has to be submitted, has to be done. Okay. Address of the beneficiary need not be exactly the same as per the LC, but within the same geographical area. Suppose certain times the description of the means that typing they make the address always may not be exactly same, or some mistakes also there, nothing to worry about, but the geographical area must be same. But contract details such as telephone means email must be same. What are the mentioned in the LC, the same details of the contract details, mainly the email ID for example or telephone number must be the same. It should not be again different. So like this UCP 600 given a more detailed description about all the transactions, how it has to be done under the LC. Complying presentation means document presentation, means documents are exactly as per the terms and condition of the letter of credit. Only LC terms only we have to follow. Other conditions there in the contract is no relevance. Only as per the LC what is there, that has to be complied. Discrepancies, documents not as per the LC is a discrepancy, that is the definition. So discrepancy which are not as per the LC, then discrepancy, and serving notice of refusal within 5 days, otherwise it will be treated as accepted. Again here see, if the bankers are not given the notice, if any discrepancies are there, that banks within 5 working days has to give the any discrepancy. If they found, they have to intimate, otherwise it is treated that it is accepted by the bank. Okay. Approach applicant for waiver of the discrepancy. If any discrepancy is there, that bank may approach the applicant. The applicant means who has opened the LC, and if the applicant is accepting that discrepancy, then of course the bankers can make the retirement of DA. But as I told you, discrepancy is also every time the bankers are asking for the discrepancy and collecting the payments. This is again a biggest area for concern with the LCs. And also one more also very clearly mentioned, must give a single notice of refusal. If any discrepancy is there, discrepancy of whatever nature is a refusal. Means you are not complying with the requirement, so you are refusing. That is what the bank will can tell. But they should not tell, say today they are given one notice, they tell this is the discrepancy. Again tomorrow another notice they will give another discrepancy. No. What are the discrepancy? They has to give in a single notice only. Single notice. Multiple notices are not entertained. Means only one time the bankers has tell these are the discrepancies. Only one time they has to tell, not multiple times. If the LC requires copies of documents and documents are presented in original or permitted, terms such as duplicate, in twofold, in two copies will be satisfied, at least one original and remaining copies. These also many times what happen, originals, suppose BL is there, you have to very clearly write BL has to be submitted in 3 originals. The BL generally you will get in 3 originals. Any of these original is a title of goods, you can claim for the goods. So therefore when you are making the submissions, you have to very clearly present these are 3 originals. Okay? A set of originals. Okay, duplicates as many you can submit, that's now here. Invoice must be made out in the name of the applicant in the same currency. Description of the goods as per the LC. So this is very important. Many people thereby they gets confused, means discrepancies. Then they put the company in a great risk. What are the description is mentioned in the LC, same description you have to mention in the invoices and other invoice, mainly invoice. The invoice and the other LC only they refer. The invoice, the same description must be mentioned. If the invoice description and LC description is different, then this is a discrepancy. And also the name of the applicant, that we mentioned very clearly the same applicant and same currency also, not in different currency. Invoice need not be signed again. It is now it is made because electronic signing and other things also there. So invoice need not be signed. Invoice need not be signed, but please do sign, because there is again, even though they mention not to sign, there are certain concerns are there. Some of the people are interpreting in other way. So therefore it is advisable, make the sign of the invoices, all the documents properly signed by the signing authority who has been authorized to sign. In GST also it is very essential that the authorized signatory only has to sign the documents, the invoice, tax invoice. Okay. Then signature, the BL must be signed by the carrier or the master or on that behalf of somebody agent. It must also indicate the power of the signatory. It indicates taken in charge or shipped on the board. This can be stated by pre-printed or notation. Okay. That means the BL must be signed BL. And the BL date also very important. Date of the issuance will be considered as the due date of the shipment. The date of shipment is the BL date. Unless BL contains shipped on board notation, in that case shipped on board will be considered as the date of shipment. So in BL also there will be different dates are there. One is the BL date. Generally BL date is taken as a date for the shipment, but certain times what happened, that actually it is on shipped on board, maybe some different date. BL must be maybe getting some early date, and means some home bill of entry, bill of lading. The forwarders, they can issue the bill of entry prior to it is put on the board. So that time, if the mention in LC it is mentioned that shipped on board, then the BL must be have the shipped on board, the date must be there, that is taken as a consideration. Only then that document BL is considered. Okay. The BL must indicate the number of originals. As I told you, originally there are 3 originals they used to give. So you have to mention 3 originals when you are submitting the documents. You have to mention 3 originals. That's very important. BL must contain the full terms and conditions. In absent of that, it will be short form or blank back BL. BL are different types of BLs are there. Blank back means that conditions are not specified. Then those are treated as a short BLs. Those are not generally taken consideration, because the forwarders and other thing also certain times they issue these type of things. Short BLs are dangerous and may not be accepted as per the LC terms. Okay. BL must indicate about freight payment. Means whenever we are making the contract, either CIF or C&F or FOB, for example, that freight payment, that condition must be mentioned. Suppose in FOB consignment, then freight to collect. Freight is collected, means collected from the buyer. Buyer has to pay the freight, the ocean freight. Suppose it is CIF, then the seller or the exporter made the payment of the freight amount. So that must be mentioned in the BL, so that indicates align with the your Incl terms mentioned in the LC as well as in the contract. Right? Transshipment, these also very clearly mentioned. Transshipment shipment is allowed or not allowed, it may be written in the LC. And transshipment means unloading or reloading of the goods from one means of the transport to the another means of transport. That is transshipment called. For example, certain times the goods goes to one place, from there it will be put into some other vessel. Transshipment, some other vessel it can go. So for example, from India to UK, that material has to go. The Indian material, the ship started from Indian JNPT port, for example, it goes to the Colombo. In Colombo, it has been transshipped to some other vessel, then it goes to UK. Such things are called transshipment. And in LC, it is a written down. Always, generally, it is preferred to write down transshipment is allowed or not allowed. The either of the option you have to mention. Transshipment is allowed or not allowed. Partial shipment is allowed or not allowed. These things are mentioned. Suppose partial shipment means, suppose you place the as per the contract, say it is 100 items. The LC also you opened for the 100 items. But part shipment is not allowed, then only 100 items only you have to export. You can't export, say, once 25 items, later you another 60 items, then 15 items, like that. No. Only full amount, full quantity has to export in one lot, only one lot. So that is what that LC terms, that is why very important to understand the LC terms. Unless it is allowed in LC, charter bill of lading is not allowed. Charter bill of means bill of lading is a separate type of generally for chartered vessel, means some entire vessel is booked for the consignment, and in that split also been made. And charter bills, BLs are not accepted under the LC unless otherwise specifically mentioned. Okay. And who is the charter party, that agreements and all thing also must be there. Under the charter party bill of lading, bank will not examine the charter party agreement, but that mention must be there. It is charter BL. Then only they will accept, other will not accept. Multimodal or combined transport document is, this also covers, but it must be what type of transportation, that also must be there. then all terms and conditions are as per the mentioned in the BL, except BL is negotiated in case of the air consignments. I'm talking all terms are similar, like BL is a negotiable documents. Negotiable documents means whoever present the document, the carrier will hand over the goods to them. But airway bill is not a negotiable document. Airway bill is not a negotiable document, but BL is a negotiable document. BL is a title of goods, but the airway bill is not. Airway bill, because in the same day, for example, the consignment is shipped from the UAE to India, and based on the bank endorsement, that person can reach to the airlines and get the relief of the goods. But airway bill may or may not be required. Okay. Airway bill is only receipt and not the negotiable document instrument. As I told you, it is not for the title of goods. Okay. Receipts are acceptable whether marked as original or not. Receipt marked as duplicate are also acceptable. In absence of indication of the number of originals, the number receipts presented will be accepted. Okay, this is again shipping related. Insurance. Document may be the insurance policy or certificate or open policy also. It can be insurance policy. Each consignment wise, transaction wise, you can take the insurance, or overall over a period you can take the insurance. In such case, open cover policy is there. Open cover also allowed, but open notes, a temporary insurance certificate, are not acceptable. Open the cover note is not open, but open policies are there. The open policies have been accepted. The issuer must mention his authority, whether as the agent or on the behalf of the writers, and date of the cover also must be mentioned. Currency of the insurance must be of the currency of the LC. Currency of the LC is insurance, it must be the currency of the LC. Same currency, suppose in US dollar, the insurance also must cover the US dollars only. Expiry date means last date of the presentation of the compliance documents at named place. If the expiry date is falls on the holiday other than force majeure clause, it will be extended to the first following working day, banking day. Application of the extended date shall not be applied to the shipment date. Okay. Here again, some important aspects. Let us understand tolerance. Tolerance is certain times tolerance is mentioned. If not mentioned, then what is the mean? Certain times we mention also about. About means it is around say plus or minus like 10%. That is approximately, or about means that is the meaning. So the exact quantity you can't know. For example, t-shirts. You are exporting the t-shirts. You write 1,000 t-shirts, about 1,000 t-shirts, for example, or approximately 1,000 t-shirts. That means plus or minus 1,000, plus or minus 10%, plus or minus 10,000 of the t-shirts. That is the meaning of it. In case LC does not take this state anything about the tolerance, then 5% plus means minus is allowed in quantity but not in amount. Suppose about and approximate means 10%. If it is not mentioned anything, then you can take as a 5%. Then you can take as a 5%, but only in quantity, but never the tolerance is not there in a value. Value is always that maximum value, within that you have to operate. So value, there is no plus or minuses, but only in the quantity. Of course, you have a plus or minus 5% you can take as a default condition. Okay. Okay, these are the some of the payment related. Okay. Types of LCs, like we have seen that irrevocable LC has no meaning. Nowadays, most of the countries restricted. On the default, of course, it is a irrevocable LC only. Always it is irrevocable LC by default. Then restricted and unrestricted, some of the restrictions for the banking and other thing you can put, those are restricted. Confirm means the third party bank confirmation. Transferable LC is also there, means that original, that beneficiary may transfer to somebody else by endorsement. So those are called transferable LCs. Then revolving LC means based on the LC is a guarantee, like it's a bank guarantee. Like suppose you have made some transaction through banking channel, one transaction is over. Suppose the after the transaction is over, that LC amount is been to that extent is covered. Then again it is a revolve means again that restores the amount. The LC, for example, you have taken for 10,000. One shipment is made for say 9,000. After that payment is made, then the LC again restores to the original amount, that is 10,000. Like that is called revolving LCs. Revolving LCs are made for the long-term contracts. Means under the same LC, repeatedly you want to make the shipments, then it's called revolving LC. Then back-to-back LC means suppose you received a LC from the US in India, and based on the strength of the LC, you want to open another LC to the Chinese party. So that is also possible. Then that is called back-to-back LC. Based on the strength of the original LC, you are opening another LC from your to your supplier. Okay. So like this, these are the some types of LCs. Now with this, we are coming out of this. Let us stop this subject. Then we'll go again to the our Now you will able to see my screen PPT. Now you able to see my PPT.
Yes, sir.
Yes. Okay. Okay. Now related to the LC, we have discussed something. LC, as I told you, this is the how the transactions happen in LC. LC, the importer opens the, he makes the application to the, there is a first a contract between an importer and exporter. Based on this contract, the importer approaches the the application is made to the opening bank. That is what the importer's bank. That is the opening bank is called, also called the issuing bank, means LC is been issued by this bank. And then LC is issued, they establishes the LC, they send to this person a copy. Then the LC will be transmitted to the advising bank. Advising bank generally located in the exporter's place country. Suppose Indian is an exporter, the bank, advising bank will be in India generally. And the importer, for example, is from the Singapore, and he make the opening of the account from Singapore, and then that Singapore bank is an issue bank. They will send to the Indian bank that LC, and then LC is being transferred to the copy is given to the exporter. Okay. And exporter then make the shipment and send the non-negotiable documents to the importer. The exporter will send the non-negotiable documents to the importer saying that he has made the shipment. Okay. And the original documents, of course, the negotiable documents we call it, the negotiable documents along with bill of exchange will be sent to the bank, the negotiating bank, or certain times the advising bank. Advising bank may be same or may be different also, but is in the same country of India, for example. But advising bank and negotiating bank may be separate or may be same. Either way it can happen. Okay. Suppose the advising bank is SBI. Advising bank is SBI. but you have a bank account with ICICI. So you can send the documents through ICICI also. Okay. Then negotiating bank will send to the issuing bank the documents. Based on these documents, of course, the documents will be presented to the importer. Importer has to make the payment and return the documents. Once the payments are made, then the issuing bank makes the payment to the negotiating bank, and negotiating bank makes the payments to the exporter. So this way the transaction is complete and it's received. Okay. And these are the various types of LCs. Already we have discussed: transfer, non-transfer, back-to-back LC, like that. There's a deferment, means LC means issuance LC. Usance LC means some credit is given. Suppose 45 days or 90 days, like that, credit is given. That is there. Maximum credit is, as per the Indian RBI regulations, 180 days credit can be given. Right. So the standard forms of documents, these are the one we have to submit to the bank, because we have to submit the documents to the bank. And some of the very important common documents are: one of the bill of exchange you have to do. What is the bill of exchange? I'll tell you. Already I told you that it is a demand. Yeah, the seller is demanding from the buyer to make the payment. That is what the bill of exchange. Then commercial invoice, packing list, bill of lading or airway bill and other documents, certificate of inspection, like that, inspection of certificate for origin, insurance certificate, other documents has to be submitted. So these are the some of the documents. Then bill of exchange. Bill of exchange, as I told you, it is a written unconditional order for payment from the drawer. Drawer means that beneficiary, for example, exporter, to a drawee, that is importer, for example, directing the drawee to pay a specified amount of money in a given currency to a drawer on a named payee at a fixed and determined future date. The due date is there, because usance credit, it is 45 days. For example, on 40th, 45th day, it has to make payment. That is the due date. Okay. Otherwise, immediate means that within 5 days they have to make the payment. That is what. Otherwise, if it is a site LC, within 5 days that has to be there. This is a draft, like a sample a bill of exchange. Like you are giving the draft number, means LC and other thing, draft number, date, and amount you are mentioning. On demand at 90 days site, for example, 90 days you have to give, specify the date of the LC on the first bill of exchange, and second 2 copies you have to send this. First and second date and tenor remains the same, being unpaid. Pay to the order of, say, your bank name and other thing you mentioned, name of the importer, that accounts A, this much of the amount. Then they drawn under the invoice number so and so, LC number so and so, LC issued by so and so. Then you write the importers and other number. Whom you are writing, that importer you are demanding. You are demanding to the importer. Importer name and address you have to write, and you have to, exporter has to sign. So this is how a sample bill of exchange. Common mistakes in presenting the documents. Common mistakes like letter of credit has expiry prior to presentation of the draft. If the LC is expired before the presentation documents, then that is not valid. Now LC is not valid, then you can't make any EA. Then letter of credit has expired prior to shipment, then it can't be made. Bill of lading, evidence of the document prior or after the date of the date range stated in the credit, then it is not allowed. And stale dated documents. Stale documents means shipment is done earlier, for example, before the opening of the LC, and you made now LC is open, whether that is allowed or not. If the stale documents are allowed, then of course it can be taken. Otherwise, it is issue. It is a discrepancy again, right? So stale documents generally not accepted unless otherwise it is specified. Similarly, there are certain other, like insurance documents. Some errors may be either insurance is not covered or less covered, and all these things also may be certain discrepancies. And invoice amount not equal to the draft amount, then also a discrepancy may happen. and port of loading related, that discrepancy can happen, and the set of documents required by the credit are not presented. All the documents as per the LC terms not presented, then discrepancy. Documents are inconsistent to a general information such as volume, quantity, etc. Of course, that within the tolerances and other things which are allowed, it's okay. Otherwise, that is also make form a discrepancy. Name of the documents not exactly described as per the credit, means what the LC is mentioned, same mentioned the that's applicant name and other details must be mentioned very clearly, same name, otherwise it will be a discrepancy. Invoice or statement not signed. Signing is a not mandatory as per the UCP 600, as I already told you, but signing is very essential. Many of the discrepancies happen because of the signing also. So take care to sign all the documents. Sometimes we have a habit that these are the electronically generated documents, so no need for signing your writing, but these certain times leads to controversies. So therefore it is advisable to sign it. Okay. And partial shipment, when it is not allowed, then if you are making, there's a discrepancy. Now export finance we'll talk about. I will go to the again video. Let us see. Export finance.
Pre-export and post-export financing. Niku has got a confirmed export order and has now started manufacturing her export items. However, there is considerable working capital cost involved in the process and Niku does not have enough money to cover all the costs. Not to worry, we explain here how the Government of India and banks can help her cover her costs. Finance can be extended to exporters at the pre-shipment stage in rupees as well as foreign currency. Here are some of the ways. Packing credit. Working capital finance can be extended in anticipation that the borrower would receive payment on export of the goods. This loan can be taken not just for packing but also for purchase, processing and manufacturing of exports. Niku needs to provide an export order or a letter of credit as proof. There is an interest which is charged on the packing credit given. Further, the firm must pledge its stocks or other advances against the credit given. Post-shipment finance. Post-shipment credit is an advance granted by a bank to an exporter like Niku after export shipment. It is always given against a proof of shipment of exports like the export declaration forms prescribed by the RBI. The advance is till the date of realization of the export proceeds. Advance against duty drawback. Duty drawback is a refund of duties like GST paid on inputs in the manufacture of export goods to the exporter. Banks can grant advances to exporters against their entitlements of duty drawback. The period of such advances is up to 90 days. Shipping bill copies containing the EGM number needs to be produced to the banks for such advances. Advance against scrips. As explained in earlier video, exporters are issued benefits by DGFT called MEIS and SEIS scrips under the Export from India Incentive Scheme for their goods or service exports. These scrips are freely transferable. They can be pledged to other parties in return for cash advances. Such transactions involving scrips are usually between individual entities and not with banks. Forfeiting. A forfeit is a French term meaning the right to relinquish. Here, Niku can relinquish her right to a future cash receivable to a third party called the forfeiter. In exchange, the forfeiter can provide her an immediate cash payment. The disadvantage to Niku here is that the value of this immediate cash payment would be at a discount to the actual receivable value. The advantage here is that any risks and responsibilities for collecting the debt are passed on to the forfeiter. Before forfeiting, Niku should go through the specific RBI circulars on forfeiting and ensure compliance. Factoring. Factoring is similar to forfeiting in concept. It differs from forfeiting in details as follows. Firstly, factoring is done on trade receivables of short maturities. Unlike forfeiting, in factoring, the buyer has legal recourse in case of non-payment and the entire risk and responsibilities are not transferred. Thirdly, in forfeiting, the export bill is purchased by the forfeiter, while in factoring, the invoice is purchased by the buyer at a discounted value. There are specific RBI circulars on factoring that Niku should read through. Interest Equalization Scheme. Lastly, the Department of Commerce or DGFT offers the Interest Equalization Scheme. Under this scheme, the interest rate charged by banks on pre- and post-shipment credit finance is reduced by 3% per annum. This reduction of 3% is covered by the Government of India to support trade entrepreneurs like Niku. For more details on packing credit, etc., Niku could approach a private or public sector bank.
Okay. So export finance also we have covered. What are the basic requirements? So any of export finance, pre-export and post-export financing is there. Hello, able to hear me?
Yes,
Hello,
sir.
able to hear me? Yeah, able to hear me.
Yeah.
And also one more thing, I'll make this whether you're able to see or not, or listen to it or not. Just to see and hear. Hello,
Able to see, sir, but not able to hear.
not able to hear. Now also you're not able to hear. Not able to hear.
Not able to hear.
Okay, good. So here, as I told you, there are two provisions are there: pre-shipment and post-shipment export finance. Pre-shipment finance is about, suppose you got the export order, basically generally a confirmed orders backed by LC. Generally banks are taken backed by LC, means you got the LC also, order you got as well as LC. Then the bankers may extend you certain credit for you to procure the raw materials or packing materials or other consumables and etc. for manufacturing, or getting the items from the local market. You have to buy the materials. So for that, before making the shipment, you have to buy certain items. For that, the bankers are making the payment. The payment they make in Indian rupees, if you want in Indian rupees. Also, if you want in foreign currency also, they make the payment. That credit will be given. Okay. And against any of the checks or drafts also, again received as an advance payment, then also they will give you. So this is what the means pre-shipment export finance. And of course, these are at certain concessional rates of OEA as per the government regulation. Time to time, what are the RBI regulations are there? Individual banks also different rates, because RBI is given certain cushion between that they can operate. So bank to bank, that interest rate also varies. It's not like standard. Every bank has their own interest rates. So that will vary because the RBI has given certain cushion for the AD, means authorized dealers, to operate within that range. So accordingly, they'll give the certain credits and they charge the interest rate. And post shipment also means after the shipment, even though you made the shipment and documents are submitted, but when the realization, it takes a little bit time. Realization, maybe you are given a credit, for example, say 45 days credit. The amount will be received on the 45th day, not immediately now. So therefore, such cases, you has to be, has to be at the working capital requirement. So bankers are giving the finance, that is called post-export finance. So pre-export finance and post-export finance, these are the two methods. Okay, and here also they can, you can, if you want, they can give you in Indian currency, or if you want in foreign currency also, they will give you. If the foreign currency is there to finance for any of the imports, for example, this amount can be utilized for that, that credit. Foreign currency is essential when imports are there. You have to make the payment in foreign currencies. Then instead of multiple times, that conversion, the conversions are always it's costly. It is a conversion rates that takes. So based on the import and export, different rates are there. Then unnecessarily you have to pay to the bank certain conversion charges. So to avoid the conversion charges, you can opt for the foreign currency that credits. So the foreign currency credit, whatever you got, to that extent you can make for the payment to the imports. So for the packing credit, you have taken anything, the credit can be balanced through EFC account also, means that exporters foreign currency, exchange currency, foreign currency, the transaction, means you can make an account in foreign currency, and in the foreign currency, what of the export means you got the realization, that can be set off. You have taken the amount as a your finance, pre-shipment finance, for example, or the post-shipment finance, and these things can be balanced or adjusted towards the your realization. Okay, and in general, these are the conditions already I told you. Whenever you are making a shipment, if you are a status holder, within 9 months from the date of export, you have to get the realization. SCZ also 9 months. EOUs and family again is 9 months. And only goods which are been exported from the warehouse outside India, then only it is 15 months. Otherwise, in all other cases, it's 9 months. In all other cases also, it is 9 months. So this is how the realization, and within 21 days, you have to get the realization from the date of shipment. These are as per the RBI guidelines. Normal transaction, this one. Normal transition, the transit period or notional due date are linked to the concessional rate of interest. Interest if you are making on the export bills. NTP means this normal transit period is an average period of normal involved from the date of negotiation or purchase discount till the receipt of the bill proceeds. And fixed due date in case of exports of use and credits, no NTP, means use and credit based on the due date as per the credit you are entitled for. Credit which you are given, for example, suppose if 45 days or 90 days, as per the due date only will be applicable, not as per the normal standard. Okay, this is the standard. This is normal transit period, is the standard periods. Otherwise, the bills in foreign currencies within 25 days, means there you are presented the documents till the realization, it must be, it is a 25 days. In bills in rupees, if it's not in LC, then it's 20 days. And export to Iran, Iraq under the UN guidance, then is 120 days. Bills drawn in rupees under the LC, 3 days, where the reimbursement provided at the center of negotiation, are 7 days for the other centers. So these are the normal transit times like that mentioned. This is standard, like, means if you are making any foreign currency related transaction and you are negotiated the date of negotiation till the payment received, it can be at 25 days in normal days. Unless otherwise, it is If it is a usance credit, based on the usance, that due date will be applicable, but otherwise it is 25 days. Interest equalization scheme also in the video we have seen. If you are a MSME registered with the MS concerned department, MSME, and Udyoga Aadhaar and other things are there, then it is a 3% subvention is allowed. For example, bankers are charging 10%. If you have a MSME and registered, then you will be given a 3% reduction. That is only equalization. If it is 10%, normal cases they're charging from you, and if you are a registered MSME, then they will charge you 7%. So 3% is given for all type of exports. But for the merchant exporters, of course, some limited only limited items only 410 items only, that HSN lines, only those lines of items 410 HS lines, means that at the 4-digit level or 6-digit level, sorry, at the 6-digit level, these only given certain 2% concession. Mean the interest will be less by 2%, means it's 10% normal rate, you will get the 8%. That is what the for merchant exporters. So okay, with this we have come to the end of the session. Okay, we are now closing the session. Anything you want to discuss, let us discuss. Of course, very sorry, initially certain glitches are there, technical glitches. I'm unable to open the files and all thing, but later we fixed it. So now it is okay.
Sir, tomorrow, sorry,
Yeah,
today evening is there.
Today evening again there is, sir. Today evening also their session, and yesterday session we have cancelled it. That I will tell you, maybe on Saturday or Sunday, next coming Saturday and Sunday we can fix it. Means on 7th or 8th, I will inform you well in advance. Maybe likely by tomorrow maximum I can inform you. So accordingly you can join the session. And the last session is important because we are summarizing, and all the other details also I'll tell you, miscellaneous, all the transactions like that. So that is important, you can join. And today again is there, 7 o'clock it is starting, 7 to 9:30.
Sir, can you brief about mover screen, sir? Application, how to apply practical?
That is I told you in the last session, definitely I will cover, sir. In the last session, definitely I will cover.
Yes, sir. DGFT or customs we need to go website?
It is customs related, sir. Mover is entirely customs, customs related. It is not related to the DGFT anything. It is purely customs related.
We need to go custom website and see.
Yeah. And last day means that is 10th day. All the miscellaneous I told you. These type of things I can cover. I can explain to you.
Okay, thank you, sir.
Okay then, thank you.